we can also just use candlesticks to do our trading. So here we have daily data for Bitcoin prices, and for any given day we have 4 pieces of information, as you can see here. So we have the opening price, so that's the price of the Bitcoin at the start of the day. We've got C, the closing price, so the price at the end of the day, and the highest price we had during the day, as well as the lowest. So that's all we know about the Bitcoin prices in our data set. Candles represents all this data. So, we have access to all the information that we have. So it doesn't, filter out things, it doesn't distort them. You get a nice, clean representation of what's going on. So this look in particular. So you have So here, you have a candle. So that's the broad body here. And then we have a thin line, so a wick. One above the body and one below. So the wick connects the highest price and the lowest price. But we can see what the highest and lowest price are. The body connects the opening and closing price. So in this case, it began at this price. What is it? That's about $49.50, and it closed at about $46.66. If the price went down, then the color is red. So then the top price is the opening price and the lower price is the closing one. While if it's green, that means that the price went up. So the bottom part is the open price and the top is the close. So that's basically candlesticks. Now there are books and books, and I have a few, looking at patterns of candlesticks, this suggests it's a continuation. So when you have a price and it's just, the market is just in an uptrend and it's remaining in that, then these are the type of candles that you get when we're having a potential reversal. You have another collection of candles. So basically people try and extract the mood of the market and what's going to happen from this information, which is at the end of the day what trading's all about. None of the patterns are always right. So you'll see a few and then you go, I like this one, so whenever I see this, I trade. But for different people, they see different things. So the one I'm going to talk about, my example, is going to be like this. So you have a big long wick and a smaller body. So smaller or equal size. So for example, say we have here, so you have a wick and it's the same, it's slightly bigger than the size of the body. When you have that, you basically go, this looks like it's turning around, so now I'm going to short Bitcoins. I put my stop loss slightly above the height of that wick, and I look to make twice that in profit. So I put in an order to sell at this price. I'll get out if it goes above this level, and I'll take profit if it goes down by twice. Some people like 3 times. So it's just trial and error. And in this case, that would have worked nicely because it went up, it went down a lot more. On the other hand, here it looked like it, but as I said, like the wick is actually, to me, this wick is shorter than the candle, so I wouldn't have traded that. Though, actually no, I'll say I would. Because it looks about the same, it's not clear. But even if I had, I would have made money because I would have shorted here. My stop loss would have been up here, and I would have wanted double that, so down to about here. And the market did go down. So if you'd followed that rule, you would have made money. Here, I'm not sure. Again, that doesn't look like it to me. But then again, I'd actually have to count. Is this actually? I think this is shorter than the candle, so I think I would have avoided that. Here, that looks like a nice long wick with a smaller candle, so I would have wanted to short that. What's that price? 43.88, and that goes up to 44.60, say. But would I have made money there? I don't think so. I think this goes down by about that amount. Oh no, but I'd be okay because it would have gone up to here. That's still below the stop loss, and I would have gone all the way down here. So this is 42.20. So it would have gone down by 140, and this is not. This is what? 90. So yeah, this would have been a stop loss 90 above, and I would have wanted 180 below this, and so I think I would have just missed. I think I would have just missed out. 180 lower than this would be 43.80, 41.80, and it doesn't go down to 41.80. So in the end, it would have gone. It would have been in good profit. But then it would have turned around, and in the end I would have taken a loss. All these ones, all these days, I wouldn't get a signal. Oh, sorry. So I want the wick to be at least as long as the candle, and I want it to be a new high or a new low. So, for example. Well, what about this? That to me looks right. It goes down, the wick went down a lot, and the candle is shorter than that wick. So then I would have gone long here with a stop loss below that, and I would have lost because it never went up by that amount. I'll just do one more. Ooh, no, I don't think that qualifies because again, there's a nice wick there, but the candle is longer, so it's a tricky one. But I would have traded it here because that's a tiny candle. The wick is shorter, so I would have gone long at 36.25, that's 120 less. So I want 240 profit. So 38.50. And it easily goes up to 38.50 because it kept going up. So that's just I'll just recap that one again. So if the market is going down and we're at a new low, by new low I mean recently new low. It doesn't have to be the lowest it's been ever or the lowest in the last year. So like this, I would say would qualify as a new low. Then I'd look at the wick and the length of the candle. This time the candle is longer than the wick, so I wouldn't go long. In this case I would, because the candle is shorter. This time I don't think I would have made money. Or, sorry, I think I did make money, sorry. If I bought it here, I would have, I think I've already gone over this example, but I would have bought it at, say, 34.10ish. It has it on the right hand side. Then the stop loss would be the length of the wick. So it would have been this high. And the price never goes that high, so it wouldn't hit the stop loss, and then it went down. So that seems to work really well in this time period. I'll just move a bit back again and see whether I'll just do one more example. So there's a nice wick there, but that's in the wrong direction. It has to be like if that wick had been longer than the candle, then that would have been triggered. Here we're going down and down. That's reversing. So I would have. Nope, sorry. This is going up, so I need a longer candle for it to reverse. So this pattern doesn't occur all that often. So we can just look back at maybe 3, 4, 5 different times when we come across this pattern, and then see how does it seem to do. It does seem to do pretty well. Though I remember I tried this kind of thing when I was trading oil, because remember when oil had hit $100 a barrel and people were thinking it's going to be 150, 200, who knows when it's going to end. So at that time you could use exactly the same techniques when you were trading oil, because these technical tools, like all of them, like the moving average, the Fibonacci, the RSI, that doesn't actually care whether you're trading bitcoins or oil or currencies or shares. They're just ways to manage risk. So now we've actually done quite a lot. Like as I said, we've looked at the RSI, the moving averages, Fibonacci retracements, and now candlesticks. There are a couple of tools which are more appropriate at the moment, because the bitcoins, the stock market, they all kind of fell a lot in the last few days. So then people are going, oh no, is this the end of the, I mean, does this mean that now it's going to be down, 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 down? Basically what does it mean? That's a classic trading question. Is this the end of a trend? So I mean, as long as a trend is going on, we keep getting higher highs and higher lows. So if we're in a trend, we just buy the dips. So whenever bitcoins fall, we buy them because they're going up. But what about when the trend ends? What about when the trend starts going down? When the trend is down, we sell when it's high, because we know we're going to be able to sell it at a lower price, or as in we'll be able to get it we have to buy it at a lower price and make a profit. So there are a couple of special methods which are specifically meant for that question, which are meant for when is the trend ending. So I'll look at one of those next in the volatility. See you then.